So Eric here, and in this video, we're going to talk about 3 tips to save you money on capital gain tax legally with a 100K portfolio in Canada. And these 3 tips will range from easy, medium, and hard. Now, chances are just implementing one of these tips will save you thousands of dollars, so make sure you watch till the end, okay? So let's get started. So I just want to start off with a quote from J.F. Kennedy. And I thought it was quite interesting because I didn't know he said that before until I did some research on capital gain. Tax on capital gains directly affects investment decisions, the mobility and flow of risk capital from static to more dynamic situations, the ease or difficulty experienced by new ventures in obtaining capital, and therefore the strength and potential for the growth of the economy. It sounds quite complicated, but let me break it down for you. The higher the taxes, the slower the economy, the worse off the state. It is actually quite simple. And if I just reverse what I just said, the lower the capital gain, more economic activity, and more people doing businesses, and everyone is happier. So that's where we're at. And it's very surprising that JF Kennedy actually said that. So as always, before we start, there's a 100 likes book giveaway, where we are giving away the Warren Buffett Way. So this is the 3rd video that we're giving out this book. So if you haven't gotten it in the last 2 videos, remember to like this video and leave a comment below. And once we achieve 100 likes, which is still a milestone for me, I haven't gotten there before, we'll give away the book. And just let me know what your address is and I'll ship that to your house. And if you haven't subscribed, which I know 98.2% of you guys haven't subscribed, just click on the subscribe button. That will help out a lot in terms of the YouTube algorithm to put me at a higher rank for specific keywords like capital gain tax. It's free and you can always change your mind in the future. So I just want to celebrate the 74th and the 75th successful case study in Investing Accelerator, where Mike made 100% on FedEx and 100% on Disney in 4 months. So congratulations, Mike, for making 2 successful trades, taking profits at the same time. So here's the problem. And this is a problem because, well, you don't want to pay capital gain taxes. And it's kind of funny because when I was doing research on this topic, a lot of YouTubers always say, I want to pay my fair share of taxes. So I don't want to be avoid tax, so on and so forth. And I guess nobody wants to get audited. But the truth is, if there is a way for you to legally not pay the taxes, if there's a way for you to take advantage of the government incentives and not pay the taxes, then you should probably do it, right? Because if you don't do it and you actually pay more taxes than you owe, then that's just stupid, in my opinion. So I think if you are able to avoid taxes legally, if you are able to reduce capital gain and reinvest in your business, hire another employee, so on and so forth, then by all means, do it. You should always do it. This is coming from an accountant. If you are able to save on taxes, why not? Why would you pay more than what you have to? And these tips that I'm sharing with you, they are government incentives. Like the government wants you to save on taxes. So why wouldn't you take advantage of it? So with that being said, that's my little rant on taxes because I think everyone should save on taxes. So let's talk about the benefits. So let's say you invest in a 100K portfolio, okay? Fairly straightforward. And you make 10% gain. So that's just like investing in an ETF fund, making 10% a year. Now this year, you're probably making more than 10% from an ETF fund. So that's great. And you are paying around 2.5% gain in Canada. Now, when I talk about this 2.5%, I'm really about the 2.5% of the whole portfolio or so. So in reality, you're really paying 25% in terms of capital gain tax in Canada. So if you apply 25% on the 10%, that is 2.5% that I'm talking about, okay? So don't get confused because you're paying 25% capital gain tax in Canada. Okay, let me just fix the sentence so nobody gets confused. So that means if you have a 100K portfolio, you make 10K, you're paying 2.5K a year. Imagine what you can do with 2.5K a year every year. You can go on a couple of nice meals, you can pay 2-3 months of rent. You can probably pay 1 month of rent in Vancouver, but that's a separate issue. But you get the idea. You can use this money to fund your children's education. It can pay for a couple of courses in UBC or whatnot. But either way, if you save on these taxes, that's great. You can use it for somewhere else. Use it for traveling. Boost the economy. You get the idea. Now, for our US friends, if you exit within 1 year, then you pay something called short-term capital gain tax, which is closer to $3,700 if you make 10K. And this is really a rough estimate. And the reason is because for short-term capital gain, it's really counted as your regular income. So it's really taxed at your personal income level, if you are getting taxed at the long-term capital gain, then it's actually closer to this number, which is the Canadian number of around 2,500 or so, okay, for every $10,000. So if I'm not being clear, or if you're slightly confused, with every $10,000 gain, you pay $2,500 in taxes in Canada and $3,700, okay, in US for short-term capital gain. So that's what you're really looking at. And imagine the amount of money you save every year for the next 10 years if you just know how to reduce your taxes properly. And I'm actually surprised because a lot of people are not taking advantage of it for some odd reason. And when I get on, strategy sessions with people, I just feel the pain because, just by using the proper account, you already saved thousands of dollars in taxes. So this video, just by going through the first couple of minutes, you already saved $2,500. All right, now let's dive a little bit deeper into this problem. So for someone like me, where I aim to get 30% a year, then my taxes is actually a lot higher. If I invest 100K, then my taxes will be around $7,500 per year if I make 10% gain. 30% gain. If I'm living in the US, then it'll be $11,100 a year. If my rent is $1,000 a month, then this could pay and cover all of my rent already, just with the short-term capital gain tax. So when you think about it, wow, there's actually quite a bit of saving. Like this is like 3 months rent in Vancouver or 6 months rent somewhere else. So if you are able to save on taxes and you make a high return, then by all means, do it. Like there's no reason for you to pay more taxes when the government is legally telling you to save on taxes because they want you to invest in the economy.
This is your lunch. Now, you should be able to do whatever you want to with this, right? If you want to eat all of it, great. If you want to throw it away in the garbage, that's your prerogative. But here I come, the government. And I get to take 40% of your lunch. And that, Lauren, is how taxes work.
So how can we save on taxes? Or how can we save on taxes legally without breaking the law and making sure the government is happy? Or how can we save on taxes like the government intended us to? So here are the 3 tips. The first tip is TFSA account. It's called tax-free savings account. And as of right now, the contribution room is around $80,000. Now, what does that mean? And that means if you put money into something called a TFSA account, the money is after tax, so it's taxed already for the year you put it in. And then you invest. And when you take it out, you don't pay tax. It's pretty straightforward. You put money in, you take money out, you don't get taxed. And you can do so for the first $80,000 that you have, okay? So in US, it's called Roth IRA. So make sure you check it out because for your first $80,000, you can invest, put it in there without getting taxed. Very easy, right? And all the banks have it, TD, RBC, BMO, you get the idea. So open that account. Even if you just put it in an ETF fund, you are making the savings on taxes already. Now, what about the remaining amount of 20K? Now, for the remaining amount of 20K, you can actually use your RSP if you want to. Now, the rules are slightly different for RSP. It is, you put your pre-tax money in. So if you put $10,000 in, you actually get your money back. And then when you take money out, then you get taxed on it. So it's actually less preferable because you get taxed when you take it out, which is kind of unfair. Well, it's not really unfair, but it's just not a good feeling because after 10 years of investing, you take it out, you get taxed on it. Great. So I would prefer to use TFSA first. Always max out TFSA first. And once you max out TFSA, which is Roth IRA in US, then you can choose to max out your RSP. So if you are confused, then here are the 2 simple definitions. TFSA, you put after-tax money in and you don't get taxed when you take it out. And for RSP, you put pre-tax money in, so you get a rebate that year, and you get taxed when you take money out. So personally, I love TFSA. I maxed out my TFSA in Canada, so that's fantastic. Now the second tip is, well, what if you don't want to use your RSP? Or what if you have more than $100,000 that you want to invest in, so you don't have enough room in your TFSA and RSP? Well, you can also save on taxes if you use your wife's TFSA. So your wife also have an 80,000 TFSA account, so you can use that room to invest as well. And if you combine both of you guys' TFSA accounts, that is 160K right now. So that is pretty comfortable. And if you look at my previous video where I talk about escape velocity and how you can retire faster and the 2 tips to retire faster, then you'll realize that, well, you can achieve escape velocity with around 300K. And if you already have 160K here, tax-free, and some RRSP, then you're pretty close in terms of achieving a high return, tax-free return, and taking income out on a regular basis. So that is fantastic. What I didn't cover here is that your children also have TFSA accounts. So if you have a children that is 20, 30, 40 years old, you can also use their TFSA account if they don't know how to invest in the markets. So this will give you even more room. Now, of course, the more people you include in this plan or using more people's TFSA account to invest in the markets, you also need to consider their expenses as well. So it means you're making a return for your family now. Your wife, your children's TFSA, your own TFSA, because so then the return you got to make is also higher. Now, in terms of the third tip, is really a difficult tip. Now, chances are if you're married, you can implement the first and the second tip. But for the third tip, you need to change your lifestyle. And it's really about opening an offshore account and becoming a non-resident. And you wouldn't be able to execute it if you're living in Canada as a resident because you would get taxed on worldwide income, but you'll be able to execute it if you are a non-resident. For US, I think you get taxed globally, so I don't think this applies to you. It'll be a bit more complicated for you guys, so you probably need to consult your accountants. So let me just bring you to this website I found. So in order to become a non-resident of someplace, it means that you need to move somewhere, right? And this actually requires a lifestyle change. It actually requires you to be traveling more. You might want to do this when you are retired, where you get to a place where it's low on taxes. And here is an article on 9 expat-friendly countries with no capital gain taxes. Now, the exact method to execute this requires a change in your residency. So you also got to consider healthcare and stuff. But here are some locations that you might considering living in because of the low capital gain tax. So Switzerland, beautiful place. Singapore, a very developed city in Asia, mainly speaking English. And Cayman Islands, beaches and the sunshine. Monaco, Belgium, Malaysia, New Zealand, Belize, and guess what number 1 is? Number 1 is my favorite city, Hong Kong. So right now I'm resident in Hong Kong. In Hong Kong, there's actually 0 capital gain tax, and it's actually fantastic. And the place is a combination of English and Cantonese, which I both speak. And there's also a disclaimer here, but you can read it if you're reading this article about the political situation of Hong Kong. And in terms of payroll tax in Hong Kong, it's actually quite low as well. It's only 17% max for personal tax as well. So that is a huge benefit when you compare to Canada or US, where the highest tax rate for personal tax is 44%. So that's pretty crazy. So if for some odd reason you're able to move into one of these 9 countries where there's 0 capital gain tax or just low taxes in general, then you can save a ton of money when it comes to living, so on and so forth. And I just want to leave you off with a quote from Einstein, which I thought it was pretty funny, is the hardest thing in the world to understand is income tax. And I thought it was relativity or black hole or time travel, but no, it's income tax. But I guess as an accountant, I can confirm that income tax is quite confusing, but you should take advantage of it if the government wants you to take advantage of those specific tax rules. So like I said, my vision is to make 30% a year. And it is like going to Mars compared to what the general market is giving you, which is around 8% a year. And when I first started, I was actually using my TFSA account to invest so I don't pay taxes. And I focus on long-term investing. I'm not a day trader, so I save on taxes there as well. Back when I was day trading or testing a lot of different strategies, I was actually not using my TFSA account because you cannot day trade in your TFSA account, okay? If you day trade in your TFSA account, you will get taxed on it. So that's why I only focus on long-term investing, because I can grow without paying taxes because I'm a long-term investor. And for the last 5 years, I made 558% return using the strategy called long-term stock options. This allowed me to make quite a good return, and my goal is to make 1,000% return in the next 10 years. So 10 times my account in 10 years. And right now, my mission is really to help people without a financial background, like engineers, doctors, nurses, construction, project managers, and so on, to make 30% a year using an hour a week. So this is really the transformation. It's very specific. It's about spending less time, getting a higher return, and becoming more confident in your investing strategy along the way. So one of the case studies from Investing Accelerator is Mike, where he made 100% on FedEx and 100% on Disney in 4 months. So that is fantastic. Congratulations, Mike. I'm very happy for you. And if you're interested in learning more about how Mike and myself are achieving this kind of success, then you want to watch the free webinar down below, because I'm going to talk about how you can invest better, how you can aim for a higher percentage using fundamental analysis, using technical analysis, using which indicator specifically, and which platform you should use specifically for charts, so on and so forth. So I packed a ton of information in this free case study, so make sure you grab it and watch the whole thing. Now, if you're interested in getting the free book in this video, which is The Warren Buffett Way, then smash the like button, leave a comment below, and once we reach 100 likes, I'll select a winner. So I look forward to the prize winner. Now, in the next video, I still haven't decided yet, but right now, this is a work in progress topic where I'm going to talk about the 3 tips to invest 50K in stocks while working a full-time job plus kids. So it's really about time management for busy moms and dads. And I thought it's going to be quite interesting, but I'm kind of in a writer's block at the moment. So this video may or may not come out. So I'll see you in the next one.